James, thanks for joining us. How did the Harmony portfolios fare in March?
Well, March was really a month of two halves, if you like.
Yeah.
It started quite weakly, but as the month progressed, confidence returned. You got quite a strong return back in towards the end of the month. So it was a month where the markets generated quite a lot of heat, not much light. We ended up roughly where we started.
Yeah.
Having said that, though, the devil is in the detail. There was lots going on behind the scenes, big regional differentials, which did actually impact the Harmony funds quite significantly. So funds like European and Asian funds investing predominantly in regions that actually did quite well over the month. They ended up in positive territory, and then the others, clearly impacted by local equity markets as much as anything else, flat or down over that period. So a bit of a mixed bag. On a 1 month view, that's a very short term period to look at market performance, of course. Looking over a longer time, 6 months, even 5 years, all the funds are in positive territory, which is a pleasing outcome, of course.
Okay, James, what then were the main themes in March?
Well, I think there were 3 important issues. Clearly, Russia and Crimea caused a lot of nervousness at the start of the month, but actually, pleasingly, we saw a pretty good outcome for emerging markets over the month. They outperformed developed markets, and maybe that reflects a starting of thawing of sentiment towards emerging markets, which of course we are positioned for in the funds. Elsewhere, China, questions over the credit markets there. We saw a default, which is part, I think, of the maturation, if you like, of the Chinese credit market. And so long term it's a positive signal, but in the short term clearly it had caused some volatility. Finally, another source of pretty short-term volatility, as it turned out, was Janet Yellen's first chair of a federal open market committee meeting in the US. She, in the meeting, ticked a lot of the boxes in terms of people's expectations. Then, towards the end, seemed to flag a slightly more hawkish stance, and I think subsequent to that, steps were taken to try and sort of step back from that particularly hawkish position that she took. Probably a misstep. Maybe it was trying to sort of gauge the sentiment of the market, but either way, that was a source of short-term volatility, but actually she moved back from that quite quickly. Against that backdrop then, equity markets flat, bond markets pretty much flat, to be honest. Property securities outperformed slightly, they returned a positive return, but it really was a month where, with the exception of a couple of niche markets, it was quite a flat month actually overall.
Absolutely. I just want to draw you. Emerging market equities ahead, EM bonds outperforming in the credit spectrum. It's got to be pleasing for you. You've been talking about this for a few months now in these podcasts. A good result in that regard, March.
Yeah, it is. I mean, it's short term as always, but it is pleasing to see a number of outcomes that we've been positioned for hopefully start to come to fruition now. Yeah.
Absolutely. Coming back then to the funds, what were the main drivers behind performance last month?
Well, we've mentioned already the big regional differentials. I won't dwell on that too much now because we've already talked about it. But across the range as a whole, overweight hard currency emerging market debt. This is dollar-denominated debt issued largely by governments and supranationals in emerging markets. That outperformed. In fact, it was the best performing area of the fixed income market that we monitor. So we're pleased to be overweight there. That added positivity to performance. Emerging market equities did well. We're slightly overweight there. That would have helped slightly. Within the fixed income parts of the portfolio, underweight governments, they didn't have a great month, so that's a useful contributor. Convertible debt did lose value though, so that would have detracted from performance slightly. And then cash is less impactful in a month such as this, when equities and bonds were largely flat. So that was a relatively neutral position in the funds.
Okay. The other position, I think across the range, James, would be the property allocations. So having gone infrastructure, securities over listed property. How did that work out in March?
Well, compared to our neutral position, we've been underweight property securities for quite some time. We've been a little bit pessimistic on those compared to the broader market. We thought they were a bit expensive, but we have been mitigating that by using infrastructure securities. We continue to do that. It wouldn't have been a particular benefit to the portfolio today because although infrastructure and property did better than the broader equity market, the infrastructure bit didn't do quite as well as the property bit this month. So that would have, although they were up in absolute terms, compared to our sort of neutral position, it would have been a slight detractor. But overall, still a positive impetus on performance.
How are the Harmony portfolios positioned today?
Not massive changes from last month, but there is one significant change. We've sold one of our 2 strategic bond managers, largely in sympathy to our view on the high yield market. We think it's getting a bit expensive. You'll remember from a few vodcasts back, we sold all of our high yield that we held explicitly in the portfolio. This is an evolution of that process, whereby we sold a manager we think is pretty sensitive to the high yield market, a market which we think is getting expensive despite the fact we've held it for about 5 years and benefited very well from it. Elsewhere in the portfolios, neutral to global and local markets, equity markets, slightly overweight emerging markets, within the fixed income portions, underweight government debt, overweight credit, including investment grade securities, convertible debt, strategic bonds, and also, I suppose, hard currency emerging market debt you could sort of bunch in that group as well. Yes. Underweight property securities, overweight infrastructure, and then we've got a healthy cash balance as well.
And finally, James, your outlook. What do you see in the coming months?
Well, in terms of what's going on in the world first, and we maybe have a quick look at valuations afterwards. I suppose Russia is a salutary reminder that you can never really model geopolitical risk. There's always the spectre of it hidden somewhere, even if it's not obvious. So don't anticipate anything else to happen anytime soon, but always worth bearing it in mind. That's why we diversify our portfolios and don't have all of our eggs in one basket. We do expect some decent growth or decent economic indicators coming out of the US. We think the weather, was pretty poor over the last sort of over 3 months really, weighing on the economy, dragging it down. And we think that now weather's improving, you get a bounce back in the economy, and that should help bring a sort of positive attitude towards US growth. Also looking at emerging markets, we may not have seen the bottom, but I do definitely think we've seen an improvement in sentiment over the last couple of months. To think again of March, a month where we had a pretty serious geopolitical event involving emerging market countries, and yet for the emerging markets to rally over 3%, and with a number of emerging market constituents up, high single-digit returns over that period, I think that is a really positive sign for emerging markets. Turning to valuations quickly, developed markets we think are roughly fair value in terms of equity, and we think there's still plenty of impetus and stimulus in the markets, particularly in this sort of low interest rate, high quantitative easing environment. I think there's still upside there for equity markets. Emerging market equities we still think are cheap, and hence why we're overweight those. Yes. Elsewhere in the markets, we think government bonds are expensive. There are opportunities in the credit markets, and I suppose in a sort of broader thematic sense, we repeated regularly last year that we thought equity market volatility was too low. This year it's certainly a different kettle of fish, and we would expect plenty of bumps on the road to continue, but an upward trend in equity markets overall.
James, thank you very much.
Thanks, Richard.